Hey guys, I hope you're all having an awesome weekend so far. I'm actually just about to head out, but before I left, I wanted to put together this quick screencast based on the reversals strategy. In particular, I've pulled out 3 reversals trades that have caused quite a bit of debate among students in recent times. So the first one we're going to take a look at is the US yen trade that's currently running. You can see here that the doji on the 8th of May caused quite a bit of questioning amongst the students as to whether it was a valid long entry. Now, my opinion on the long entry of this trade is that it's actually not a long reversal. You can see here that price is forming this triangle pattern. This means we're seeing higher lows and lower highs. There's no downtrend present and no uptrend present. It's sort of just consolidating within this triangle. Now, the problem with trading long here is that we're trading long right into this resistance line. That's not a good time to be trading long. And on top of that, prior to this doji forming, price didn't really move down over the last few days, which is one of the criteria of a reversal strategy. So the problem with trading long when price doesn't move down over the last few days is that price doesn't really have anything to be reversing from, which is the underlying nature of this very strategy. So in my opinion, that's not a long reversal, nor is it a short reversal back here. Having said that, I am long US yen. And the reason for that being so is that I'm long based on a power trend on that candle there. So I'm aware that a lot of you guys are still using the FXCM Trader Station software, and I've taken a quick look at that, and I've noticed that this particular candle here is green candle, meaning you wouldn't have got a long power trend. So the reason that I'm long and a lot of you guys won't be is because of sheerly because of data discrepancy between eSignal, which is the software we use, and the FXCM charts, which is the software that we recommend beginners use. Now, if you want to get this software, you can buy eSignal yourself, but it does cost a bit of extra money. So what we recommend to students is don't get eSignal unless you are trading live and you can your profits justify the payments of the professional data. Or if you have a lot of extra money to throw around to get the best data available, then get it as well. It is better. It will give you better performance, and your analysis will be a lot better as well, because these lines stay here. They adjust as you move the charts. It's just a much better, well-rounded program. Now, there's a bit more information that I put on the site yesterday in lesson 10 moving forward. So if you want, cruise over to lesson 10, log in, and check out the section on eSignal that we put in. What else was I going to say about US yen? That should just about wrap that part up. The next trade that I want to look at is the US CAD trade from a few weeks ago. This one was discussed in the weekly market review, I believe. But I want to look at it, I want to show you guys the chart. So right here, we entered short based on this doji that happened at the top of the swing high on the 24th of April. Now, this isn't the neatest reversal setup, but it is a very good one, and I'll tell you why. The reason it's not neat is because price over the last few days actually didn't move up. We've seen price consolidate here for 5 days. So let me just zoom in for a second. Okay, on this candle here, price closed at this price, which was around about 102.60. The next day it opened there and closed pretty much there as well. The next day it opened there and closed a few pips higher. The next day it opened there and closed there. The next day, you can see the pattern. You see where I'm going with this. For 5 trading days, price closed and opened at exactly the same price. So what this tells me is that there is massive equilibrium between buyers and sellers. When you can see this kind of equilibrium, and it's rare, but when you do see it, the chance of price exploding in one direction is pretty high. So what we've done is we've put a short order in and captured that movement. The line that I have drawn in here, when you're looking at it based on this zoom level, it doesn't actually look that great. You can see it meets a lot of the open and close prices here, which is great, and maybe a little bit there and there, but this line doesn't look too great. So the next problem that I wanted to talk about with reversals regarding something that students are doing a lot is they're not looking at the bigger picture, the big picture enough. A lot of students I find are really zoomed in. I get a lot of screenshots. I get a lot of screenshots to my email address with students that are looking at charts kind of like this, saying, is this a valid trend line because I've got a touch there, a touch there, a touch there. I've got about 5 or 6 touches. Is it a valid trend line? Well, no, not really. You really need to look at the bigger picture when you want to draw trend lines. So what I will do now is I'll zoom out to a crazy level, and you can see here that all the way last year, mid last year, this line held price there, again there, again there, again there, 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 and there. This is going back to 2009. This particular line held price. So what you want to do when you're drawing trend lines is really look at the bigger picture first, then zoom into a smaller time frame. I'm sorry if these charts are lagging your system. They're lagging mine a lot. This is because the screener software that I'm using to record this video seems to just freeze up the system a lot, but that's okay. So this line is actually really good, but it's a longer term line, which is something that I would recommend everyone start doing. Look at the longer term first, then zoom into a smaller time frame and do your analysis there. So that particular trade was a reversal short, and it was very profitable. I thought that was a great trade. And the final trade that I want to talk about really quickly is a Euro US from quite a number of months ago. Actually, what I'm going to do is remove these EMA lines so that we can have a clearer look at the charts. There we go. The trade that I want to discuss is this bullish engulfing from back in January, the 10th of January earlier this year. One of the things that I wanted to convey in this video is to be very wary of engulfing patterns. Trade them sparingly. Actually, I probably only trade a handful of engulfing patterns each year. The reason being is because to get a one-to-one reward risk is very, very difficult. The reason for that is that there's such a high pit risk. So if we wanted to trade long here based on this engulfing pattern, we'd be trading a pit risk of around about 241 pips. That means to make 1% profit, price would have to move 241 pips up. The chance of that happening, I mean, there's definitely a chance of it happening, but even if it does, it's a huge movement just to make 1%. So in this particular trade, we only made a fraction of a percent because the candles is so big and we had to have such a large pit risk. The larger the pit risk, the smaller amount of margin we can put on that trade to keep our risk at 1%. So because we have so little on the trade, it takes a big movement to make any kind of significant profit. What would be a better trade would be this doji here. Because it's so small, we can get a tidy pip risk of about 85 pips. So that trade actually ran 214 pips in profit. So if we use a calculator, we can quickly work out that 214 divided by 85 is about 2.5% profit that move would have captured, which is a lot better than entering way up here and capturing only a fraction of a percent. So this is something that you should be wary of as well. Trade your engulfing patterns sparingly. I only trade a few every year. The most profitable trades that you are going to get come from small candles. This is because we have small pip risk, which means we can load up the position and have a lot of money on the trade, still keep risk low, and then price only has to move a short distance to make 1%, then only a short distance to make 2 and 3 and 4%. Your big trades will come from entries with small candles. On top of that, the price action surrounding this reversal long is not the best, admittedly, but these trend lines here are really great. Again, if we zoom back and look at the bigger picture, we can see quite a number of touches with both the upward sloping trend line and the downward sloping trend line, which has held true for years and years and years and years. So this is a really great line which really helped justify that long reversal. So anyway, that's a quick look at 3 reversals that we've taken in the last few months. Hopefully that helps. What I plan to do is push out a few of these videos on reversals and just cover 1 or 2 or 3 reversals like this. Hopefully over time, by looking at what we look at and getting an understanding of how we see the charts and what lines we're drawing in, hopefully it'll help to align your analysis when you go to place reversal trades as well. So that's that, and I've got to run, but thanks guys, and we'll be talking soon.